14. Let me start with the last sentence, even though it's not numbers. Which product had actual sales in excess of budget, and what margin does OE divided by OF represent? Okay, this looks like, so now this is how, what I like to call uglifying. They're taking a concept that's not too ugly, not too difficult, and now they're kind of making it ugly. All right, so let's see what they're doing here. All right. We've got this beautiful graph. It looks like this. Well, that was supposed to be straight. Looks like this. We got OE. We got F. We've got that. We got that. And that. Okay, so this is G volume dollars. Okay. So at zero activity, we're going to lose this much. This must be fixed costs. It says in the budgeted profit volume chart below, OG represents a two-product company's profit path. EH and HG. Okay, EH and HG. And actually HG goes, it's not straight across, it goes up a little more. So here's G. Okay. Products 1 and 2 respectively. So this is product 1, product 2. Sales price and cost behaviors were as budgeted. Actual total sales equaled budgeted sales. So sales were not different. And there were no inventories. Actual profit was greater than budgeted profit. Which product had actual sales in excess of budget? Okay. Now, in just looking at these two, what did we learn earlier? We learned that if this is steeper and this is flatter, the steeper one is going to have more profit per unit, right? Because that angle, that's the variable, right? So that's going to be steeper. So that's going to be more profit. The other thing, they're saying, what is OE divided by OF? OE divided by OF. Let's see. OE is fixed cost. OF is the quantity sold at break even. Because at OF, that's going to be the quantity we sold at break even. So that means that our break even in sales dollars equals fixed costs over CM ratio. So therefore, our break even equals fixed over CM, or CM ratio. Therefore, if you were to come up with break even, bring that up. So if you end up with fixed over break even, that equals CM ratio. So if our break even in units, fixed over CM, so break even in units is fixed over CM. Therefore, if we want to end up with what? They're saying, what is OE divided by OF? OE is fixed. OF is break even units, because that's quantity volume. I was thinking it was dollars, but it's not, it's volume. That would equal your CM. Because isn't break even in units equals fixed dollars over CM dollars? Yeah. So therefore, if we were to multiply each side by CM, divide each side by break even in units, you end up with fixed over break even equals CM. So therefore it must be CM contribution margin. And which product we sold more of? You must have sold more of one than two, because this is steeper, therefore steeper, more profit, because that is our profit going up. So that was a tricky question. Read the solution carefully, but again, it's the kind of question that this would be in the difficult. Remember, we have moderate questions and difficult questions. This would have been one of the questions that they said, hey, let's throw it on the exam, and we'll throw it in the what? In the difficult area. So what did we cover in this section? Just to kind of quickly review, we went through and we talked about things like starting out with our different costs, we said we have Y total cost equals fixed plus variable times X. So we went through and did this. Total cost equals fixed plus variable times X, where we said this is the dependent, this is independent, this is independent, this is dependent. Y equals fixed plus variable times X. This is dependent upon this. All right, and when you graph it, this is your X, this is your Y. Here's your fixed cost, here's your total cost, here's fixed, here's your variable. As we look at that, we're going through and solving. That's also called your flexible budget equation, which we're going to look at in another section. We talked about manufacturing costs. What are manufacturing costs? We said direct materials, direct labor, factory overhead. These two are called prime. These two are called conversion costs. We went through and we said variances. We'll deal with that in the next section. What could go wrong with this, with this, with this? That's called variance analysis. We also went through and talked about the flow of a cost system. We said the flow of a cost system was you got your raw materials, work in process, finished goods, and it goes beginning plus purchase is available minus ending is raw materials used. That goes into WIP. You got beginning plus direct materials, direct labor. What kind of overhead? Applied based on a predetermined overhead rate. What was your predetermined overhead rate? We had estimated over estimated. This is called the numerator denominator. You come up with your cost per unit times actual equals your applied. That's what we're going to put in here. That equals WIP available minus ending is cost of goods manufactured or completed. Where do they go? Go to finished goods. Beginning plus cost of goods manufactured is finished goods available minus ending is cost of goods sold. Boom, cost of goods sold. This is where you adjust over, under, applied. So that was the flow of a cost system, and that's how it flows through into the accounts and the different amounts that we were concerned with. Then we talked about variable and absorption costing. Absorption gets absorbed into ending. Variable, prime, direct, contribution margin, we used in break-even analysis. That's called variable or absorption costing. And we did those two income statements. The big difference was the treatment of your fixed overhead. Under absorption, it gets absorbed into ending. Under variable, direct, prime, it gets expensed as incurred. Remember PSA, production is greater than sales. Profit is greater under absorption. Cost, volume, profit, two important formulas. Fixed cost plus profit over your CM equals break-even in units. Fixed cost plus profit over CM ratio equals break-even in sales. We just looked at that last question about that chart. It was tricky and difficult, but it said, what is your fixed cost over break-even in units? That was your contribution margin. What was the slope? The difference is the profitability is going up faster here than here. We must have sold more of this product than this. That's why we made more profit based on the same number of sales and same everything else. All right? That, my friends, is decision making. Study hard. We'll see you soon.